Morning Call. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. Welcome to Bazaar Morning Call. This comes live from the CNBC-TV18 Motilal Oswal studio. I'm Lata Venkatesh. With me, my colleagues Prashant, back from his holiday, and Nigel, of course, has been with us. Well, just to bring you up to speed, we put behind a rather difficult Thursday, but we are heading to slightly negative cues from the global markets. Actually, we are in a situation where good news is bad news, and the good news was very strong private sector job creation in December. The data called ADP data is indicating that 235,000 jobs were created, and the expectation from analysts was just about 153,000. So it's extremely strong. And as if this was not enough, you also have very strong cues coming from the jobless claims. Now, this is claims filed by people who have unemployment, and the last week, the week to December 31, saw claims of just about 204,000, whereas the previous week it was 223,000. So the number of people who are asking for jobless claims appears to have declined. This is again indicating of a strong labor market. Doesn't quite gel with the 18,000 jobs that Amazon is willing to sacrifice, but clearly this is something the Fed will watch very closely. Now, the impact has been that obviously equity markets, you saw a 1% fall in all the Wall Street indexes. You saw bond yields rising. But my submission would be that the bad news or the worry that one is expecting from the non-farm payroll numbers, which will come today, that is government data. That's coming from the Labor Department of the United States. That news is perhaps already in the price. So what we are seeing actually now is Wall Street indexes, stock futures, showing a shade of green, as are Asian indexes. The possibility is that if there is any negative news coming in from the payroll numbers tomorrow, later today, that is perhaps in the price. I would take that as a likely positive for the markets. Prashant, what do you say?
I mean, it's pretty interesting, right? We're starting the year almost exactly in the same place where we were last year in terms of the worries, right? It's macro, it's global, it's central banks. Absolutely. And what they're likely to do. So just a couple of brief points. As you said, I mean, you've got the high-frequency data points, which are all pointing to a tight labor market in the US, right? I mean, you hear these headlines of large tech companies laying off people, but what is that as a percentage of the aggregate workforce? It's minuscule, right? So one has to keep that in perspective. So as Lata said, we have the claims and the ADP numbers, which were stronger than expected. We had the JOLTS number the day before, which was stronger. Monthly jobs data later today is crucial. That, of course, comes around US market opening. And that is the single biggest data point. Labor market tightness is what the Fed is watching. Actually the highlight, I mean, the jobs number later today will be the highlight. But so far, the highlight has been the FOMC minutes, right? Which we discussed yesterday. And the Fed is clearly saying that the market is getting this wrong still. It's leading to easier financial conditions, which is making our job, which is the Fed's job, more difficult. And in that sort of regard, market pricing of Fed's terminal rate has not moved since mid-October. If you go back and look at all of the legs of correction we've seen in US markets in 2022, each has been followed by the market pricing of Fed's terminal rate sort of moving a leg higher, from 2 to 2.5, 3 to 3.5, from 4 to 4.5, 4.75, etc. It's stuck at 4.75 since mid-October. And this could be a potential risk. If we see faster disinflation, it's possible, right? I mean, 2 data points and suddenly this worry is in the rearview mirror. But the fact is, if it does not play out like that, it's possible that market reprices this higher once again. And that is negative, as we've seen through the course of 2022, negative for risk assets. So that is one point, but it's like a possibility. Now, what's been happening here in India? You could look at day-to-day price action and not if you kind of sort of, for example, for the week since last Friday's close, the Indian market is down 0.5, 0.6% after all of the big moves we've seen day before yesterday, etc. But if you just extend that timeline a little bit, I think it kind of, if you zoom out a little bit, it helps you understand what's going on a little better. The big global underperformers of 2022, which is sort of markets like China, regions like Europe, they've come back pretty strongly in the last 2 months. You just go back and look at data from the 1st of November till till date, right? I mean, I just looked at, did that exercise for the Hang Seng against the Nifty. The Hang Seng is up 47% from its lows in late October, and the Nifty is absolutely unchanged, some 45 point change in the last 2 months, a little over 2 months or so. So it's, there is a bit of pullback away from the big outperformer, which has been in India. And of course, I mean, there is money which is moving into markets like Europe, markets like China, etc. as well. Where do we come in here on the Nifty in terms of levels? Last 2 or 3 sessions, we've kind of again gone back to this pattern of lower highs and lower lows. Very simply put, if the market's got to come back and find its feet, that needs to be broken. The support for the Nifty comes in at about 17,961. What is that number? That number is the 61.8% retracement of the rally that we see, 500-point rally in 4 sessions that we saw from the 26th of December low to the 30th of December high. That is 17,961. We broke that yesterday, but we closed above it, so that naturally becomes the first. On further decline, yesterday's low comes into play, which is 17,892, and then the low that we saw on the 26th of December, which is 17,774. These are numbers to watch on the downside. On the way up, I mean, the Nifty has got short-term sort of hurdles in the region of 18,245 to about 18,265 kind of levels. But we are, I mean, so far the market kind of seems to have lost its mojo a little bit. Nigel will talk about fund flow, etc. over the last couple of sessions, and that is also clearly showing that maybe at the margin there is a little bit of kind of realignment which is happening out of the big outperformers, as I said, of 22. India has been a stark outperformer into some of the underperforming markets, and that is, I mean, I guess par for the course. If we are able to kind of hold these levels and not go down very, very sharply. Nigel, what are you watching?
Well, yesterday the call that we made was don't chase the morning opening. Yeah. Look for that intraday dip. We got maybe a deeper gash than expected. But the question is, did the weekly expiry, in fact, come to the rescue of the bulls? Because there was some covering that took place, and that's why we did see a bit of a bounce yesterday. So the bulls managed to dodge the bullet yesterday, at least for the time being. The 17,900 odd mark got protected. And the problem yesterday was your star performer, the Nifty Bank, that was underperforming yesterday. Though in the final hour of trade, it pulled back and it ended closer to a crucial technical level. It ended right on the 50 DMA odd. So that's going to be very, very important today. Was it a trend that is changing, or did the Nifty Bank just have an off day? For me, the positive though yesterday was the mid-cap outperformance. Even in a wobbly market, the mid-cap index gave you good returns. It was up close to around 0.5% odd. The flows, that's a bit of a problem pocket. The FIs have been selling for the last few sessions. 10 sessions, they've sold 11,500 crores odd. And the bigger concern is normally look at the FI and the DI data together. Out of the last 8 sessions, 7 sessions, they have been net sellers. And if you take a look at the trend as well, that should come up for you at least for the last 5 sessions. What do the FIs do then in the F&O market? Well, we were talking about short covering. That played out yesterday. Some part of that, and that could be the reason why we bounced, because the cash market flows weren't encouraging. So yesterday we did experience some bit of short covering. 12,000 short contracts were closed out, and there was some long addition as well. And now the short positions have come down to around 59% odd. So they're net short in the index. It's not a bad thing. They could be forced to cover out in case you get some bit of good news that comes out. Options data as well, 18,200 call, 18,300 call odd is seeing aggressive writing. So we could get a relief rally. But my sense is 18,250, 18,300 is going to be very difficult to get past on those levels. At the lower levels on the put side, 17,600 put, 17,700 put, they opened up. There's buying being seen out there, premium at 20 to 30 rupees. But the 18,000 put, that saw addition that has close to around 100 rupees of premium. You deduct that 100 rupees from around that 18,000 odd, and you get your crucial support, which coincides bang in with the technical levels on the Nifty itself. The Nifty 100 DMA comes in at around the 17,900 odd mark. Yesterday's low as well is out there. So the 17,800 to 17,900 mark, it's very, very crucial that the bulls defend that mark. The Nifty Bank, well, the crucial levels as well come up for you on the screen. We ended near the 50 DMA. Let's hope we end somewhere around that. Otherwise, there could be a bit of a slippy slide towards the 100 DMA. SGX Nifty suggesting a flattish start. Intraday dip will come today. We are seeing the SGX Nifty recover from the day's low. But that 17,900, 17,920 risk reward could favor the bulls like we saw yesterday. What else, Radha?
Yeah, it's quite possible because, at least the stock futures at the moment are indicating that the worst is behind in the global markets for the week. If that happens, I mean, if the stock futures continue to point to, the worst is behind and the non-farm payroll numbers are already in the price, then probably the shorts will want to cover more. But we will have to wait and see. Just a word, you were speaking about the North Asia and China outperformance.
Yeah.
This was something Morgan Stanley spoke about and said that India is too pricey. I think it was in end November that, and since then we have seen the outperformance of North Asian markets as well as China, more importantly China. Okay, just an important data point that will come in today, and that's the first advance estimates for the GDP of the current year from the NSO. It's an advance estimate. This is not a forecast like RBI and the banks make. This is actually an estimate, so it's got its own importance. But more importantly, only in this number you have to look at the nominal GDP, not so much the real GDP. Because the nominal GDP is, as per our poll, expected to have grown by 15.8%. That's largely because inflation was much higher than what we began with in the beginning of the year. Now, this 15.8% growth in nominal GDP will mean that the size of the economy in nominal terms will be about 269 trillion rupees. Now, why am I giving you this number? The budget on Feb 1st last year had estimated that the economy will grow by 11.1% nominal, and that size would have been 258. Now the economy is 269, so it's a much larger economy in nominal terms, and therefore you can have a higher fiscal deficit. Now, if you have a nominal GDP of 269 when you end this year, the government can assume a larger, probably some 10-11% for next year. So they have accordingly more fiscal deficit space. Now, all this math is only important to the extent that the budget process starts today. Once you get this number, is the nominal GDP this year 269, 265, 270, whatever the NSO tells you, based on that, the government will start working its numbers for the budget. That's why this becomes important. It's not market moving, but it's a very important arithmetic base for the budget preparations. And of course, we will discuss that at 5:30 when it is announced. The higher nominal GDP is going to allow a higher fiscal deficit this year, but that is all very well known. So we know that the deficit is going to overshoot, but it will be hopefully within 6.4 because of the higher numerator.
Okay, let's quickly run you through what is lined up on the first half hour of the show today. We'll get you updates from markets across the globe. And Ed Yardini, president at Yardini Research, will be with us to discuss the global trade setup. Later, our research team will bring you CNBC-TV18's list of top 10 stocks to watch out for the day. At around 8:30 this morning, we'll do a fundamental stock analysis with Prakash Dewan of prakashdewan.in.
Okay. Now let's get to the equity call of the morning. We have a call coming from Victor Schwetz of Macquarie. Schwetz says absolute and relative performance of emerging markets in 2023 will critically depend on the macro outlook. He believes that the macro environment will be more supportive for EMs, offering an opportunity to meaningfully outperform developed markets for the first time in a decade. Although they maintain a negative secular long-term view over the next 12 months, emerging markets should be helped by falling inflation, lack of globally systemic fractures, central banks' ability to better balance growth versus inflation, and lower US dollar and higher yen. Victor Schwetz adds that performance of emerging markets should also be bolstered by their expectation that China will continue to re-rate, reflecting a powerful mix of reopening, fiscal and monetary stimulus, expected lower intensity of geopolitical and regulatory pressures, as well as lower valuation. All told, a good year possibly for Asia.
All right, Lata. We'll continue to get your opinion, but here is some live opinion now. Ed Yardini is president at Yardini Research. He's joining us now to take some questions. Ed, great to have you back on the program at CNBC-TV18. Thank you very much for your time. We were looking at the sharp outperformance in markets like Hang Seng, etc., and kind of correlating it, contrasting it against the tepid last 2 months that the main Nifty index here in India has had. Right. Is that, 2022 all told has been good for India relative to the rest of the world. So is this just some rebalancing, money chasing the big underperformers, which is going on?
Yeah, I think that's absolutely correct. I think global money is looking for better valuation multiples in an environment where the major central banks are raising their interest rates. So it's absolutely a rebalancing, but rebalancing it tends to be more of a long-term approach to running money. I think a lot of this is trading money. I think people are betting that now that China has abandoned zero COVID, that they will get a very intense wave of infections, but herd immunity may occur sooner rather than later. And so people are looking for peaks in this wave, and some are seeing some here and there. But all in all, I think it's a lot of it has to do with chasing China, which got awfully cheap with the zero COVID. But in addition to that, India, it's had a great run in 2022, and I think it's due for a bit of a rest. I don't think it's going to be much of a correction because, as you mentioned, there is increasing interest in emerging markets in 2023, and India certainly is at the top of the range of a lot of emerging markets in terms of the underlying fundamentals.
Okay. Good evening, Ed, and thank you very much for staying up for us, and have a very happy New Year to you. Have a fabulous 2023. How do you understand what the FOMC was telling us and the jobs data that we have got on Thursday? The Fed seems to be saying that you guys are pricing in rate cuts and that's making our job tough. Now, that seems to be the message, but how will the markets move forward on this?
Yeah, I think that's one of the reasons the stock market in the U.S. did badly today is everybody read that one little sentence in which they said, the Fed officials basically told markets, you're making our jobs harder because you're not going down enough. You're not creating enough financial tightness. And so I think the Fed really just wants to communicate that they are going to raise interest rates some more. I think they're going to go to 5.25%. And I think then what they're trying to convince the markets is that they're going to stay there for a while. Historically, that's very unusual. Historically, the Fed raises interest rates and then overdoes it, and then rates start coming down. So I think the Fed doesn't want to overdo it. I think they want to get it just right, and they're sort of upset that the markets are making their jobs a little bit harder.
All right. Good morning, Mr. Yardney from here in India. Mr. Yardney, there's been a lot of focus on emerging markets, India and China. I was looking at yesterday's performance itself, and the FTSE, that's suddenly doing a relative outperformance. And the FTSE is actually closer to its all-time peak, which is a bit of a surprise, right? What's your sense about, some of these developed markets? Some of them got bombed out last year, and they've quietly clawed back. Your view?
Well, I think all in all, over the past couple of years, it's been pretty clear that the United States has sort of been the hot market among developed economies, and got too hot, led by basically 8 stocks, the so-called mega cap 8. Their valuation multiple got to over 30. Now it's closer to 20. And so a lot of what's been going on in terms of relative performance has actually been led by 8 stocks in the U.S., and now they're clearly underperforming. And as a result of that, there isn't the perception that the U.S. is going to necessarily be number one. And now all of a sudden people are looking for better valuations, and they're finding them in China, they're finding them in Europe. And Europe, of course, still has some challenges, but sort of the worst case scenario of a bad recession in Europe, because it would be a very cold winter and they just wouldn't have enough fuel to heat their homes and their industries. That hasn't panned out. Quite the opposite. The weather's been remarkably warm, and storage of natural gas is running around 95%, and they've been able to kind of protect themselves very, very well. So I think the investors are going more global now, maybe giving less emphasis to the U.S. in areas that have outperformed, like India. But I don't. I think the underlying fundamentals for both India and the United States are actually still pretty healthy. I tend to be one of the few optimists on the outlook for the U.S. economy.
Okay. Now, how would you, see the current year coming up? Will it be much like last year with big falls in the U.S. and less so in countries like India and Asia? What would your pecking order be?
Well, you're saying what would the pecking order be? I would say
questions,
that,
two separate questions. What would you say would be the kind of fall or performance of the U.S. markets? And what would your pecking order be?
Well, the consensus view on the U.S. stock market is that it's probably going to be flat this year, but the consensus view is that it's going to be down in the first half of the year and will make a low by the middle of the year and then rebound. I'm thinking that the U.S. stock market's going to continue to be in this range just below 4,000 and maybe above 3,800 for the next few months. And then I think it moves higher. I think this year is going to be an up year for the U.S. stock market, but it's hard to get wildly excited about the market because valuations are still relatively high at around 15, 16, and earnings are going to be challenged. They're not going to go up, but I don't think they're going to go down. I think they're going to go sideways, but it's not a very exciting environment. I think, again, the focus is on valuation multiples, and we know that Asian markets have been relatively cheap compared to the U.S. European markets have been relatively cheap. So maybe for the first 6 months of this year, the opportunities will be outside the United States rather than the focus on the U.S. I think there's still some ways to go for the mega cap 8 to give back some of their overvaluation, some of the air out of their bubble.
All right, Ed, thanks very much. Great speaking with you. It's
Thank
always
you.
a pleasure having you with us here on the program. So it gets a little worse before it gets better. The question is how worse and how quickly does that start to turn? At what point in the year, if it does turn this year? We'll take a quick break here. Our list of top stocks to watch lined up next with our research team. Stay with us. We're back with that. Okay, welcome back. We are sort of counting down to the market opening. We got the global sort of behind, the global setup and implications behind. Let's get to our research team, which is standing by, and let's talk about the top stocks we are watching out. IDBI Bank is the first one. Abhishek is standing by with to tell us why. Abhishek, hi, morning.
Morning, Prashant. So, IDBI Bank will write to exchanges to classify government holding as public after the divestment takes place. So, new acquirer of the bank will meet the minimum public shareholding, which is about 25%. So, post divestment, Government of India will not exercise control over the affairs of IDBI Bank. They'll not have any special rights with respect to the bank, and also the fact that none of the government's servant will have any representation on the board or act as any key managerial position in the bank as well. The voting rights of Government of India will not be more than 15% of the total voting rights, and reclassification as public is with respect to the open offer that is being made by the acquirer. Back to you.
Okay, so hopefully that should have an impact. Sonia is joining us on CAT. Sonia, they're expecting a good growth this year?
Oh yes, they put out a target of a $2 billion revenues that they're looking at in the near term. Now they're very optimistic, but they haven't given an exact timeline. But the way the trajectory of the revenues are going looks like they could meet that by FY25 itself, the $2 billion target. Now, their focus is more on the passenger car tires as well as the off-highway tires. Remember, currently CAT is the #1 player in the two-wheeler market, but now they're looking to expand further into the passenger car segment through the SUV segment as well as in the farm equipment space. So they do mention that they've made strong gains in the European Union as well as in the US markets over the last 5 years in farm tire manufacturing. Now, Elara Capital put out a view that this $2 billion target is slightly higher than what the street is estimating. So that's a bullish view coming in from the management, and hence I'm going with green. Elara says that CEAT could touch $1.8 billion revenues by FY25. If you look at the trajectory, up until FY22, they've already done 9,300 crores. If they grow at about 22%, it would mean 11,500 crores by FY24. And then if they grow by 30%, that would mean touching the 15,000 target by FY25. So it looks feasible, but it's yet an ambitious plan. The additional positive, of course, is the fall in rubber and crude prices. Rubber prices are down 24% from the April 2022 highs. Crude prices are 40% lower. So expect CEAT's margins to improve further, which in any case have been on an upward trajectory for the last couple of quarters. Back to you.
Okay. Well, thank you. Okay, I just wanted to say that Sonia is away for an exclusive show, and she will be back with us later on for the second half of the day. And of course, we make her work even when she's far away. All right, let's get to Vivek. Vivek, you have a bunch of stocks on your radar.
Good morning. Yes, quite a few stocks on the list. So Force Motors, it's given a production as well as a sales update. Total production is a little over 2,300 units, up almost 12% on a month-on-month basis. Domestic sales is up almost 14.6%, coming in at the 1,861 units. And export sales have jumped up almost 27%, coming in close to the 430 units mark. The other stock on our radar is RVNL. Now the company has got an LOA for a project worth almost 166 crore, and this is for track development project from Surat Metro Rail. Also keep an eye out for on Pokarna, a significant relief coming in there. Remember, the US Department of Commerce had started an anti-dumping duty investigation into the company for quad surfaces that the company exports to the US markets. However, this is a relief. The US Department of Commerce has decided that there has been no, the company has not sold these particular products below the fair market value, so there will be no duty imposed on Pokarna. Also keep an eye out for DFM Foods. It's been a successful delisting from Advent International. The final delisting offer price was at 467 rupees a share. A little context here, the discovered delisting price had come in at 525 that Advent had rejected and had given a counter offer of 467. That is now successful. The initial delisting price was at almost 263.8 rupees a share.
Okay, all right. Thanks a lot for that, Vivek. Well, Vaistha is joining in to tell us about a few more stocks that are on the news. Morning, Vaistha.
Good morning, Nigel. Let me start off with Mukund, wherein the company has completed the transfer of approximately 46 acres of land at the facility in the Thane district. Now, remember, the aggregate consideration has been at about 796 crores, and part of the funds were already received earlier. Now, this deal is expected to reduce the borrowing costs for the company. As on 30th of September 2022, the interest cost was at 46 crores. Moving on to Segachi Industries, when there's going to be a board meeting scheduled on the 10th of Jan for the proposal of raising funds by way of issue of equity or convertible warrants on a preferential basis. And the last is some of the steel players which will be in focus. The HRC prices have risen in China, and this is likely to aid sentiments for domestic steel players such as JSW Steel, Tata Steel, etc.
Okay, thanks for that, Vaistha. Well, let's do a quick recap of all the top stocks we just covered for you. Stocks with positive news flow include IDBI Bank, CEAT, Force Motors, RVNL, Pokarna, DFM Foods, Mukund, Segachi Industries, Tata Steel, and JSW Steel. While for today, well, we have no stock that is going to be reacting to negative news flow. So hopefully, most of them open in the green.
All right, with that, let's get to the commodity cues. Manisha Gupta is waiting by. Manisha, steady as she goes for crude.
Yes, it does. It's holding firm there, but below $80 per barrel for both the varieties. It has been very volatile and choppy, but yes, for the last 24 hours, it has been within that range as well. But not so the case for the natural gas, where we have seen further decline now coming in. Last night was yet another 10% of a fall. So for natural gas, we're trading at a new 52-week lows right now. So the gas prices fell 35% in the month of December, and they have declined 18% for the month of Jan as well. There is lower heating demand, the warm start to the northern hemisphere winter, and Europe looking at record high temperatures. All of that is weighing on the gas prices. But the metals in the overnight markets have done well with the decline in US dollar, and now China reopening even more. The metals as a sector overnight was one of the gainers.
Okay, that's important to note, metal gainers. Also, the dollar index ended pretty high yesterday. I mean, there was at least a one
It's made
tick
an
move.
impressive comeback across a range of currencies, back above 105.
Yeah, so we'll have to see whether it has any impact on the currency. The rupee strengthened yesterday because of the fall in crude prices. We have to see whether this has an impact. Along with higher metal prices, it may be positive for the steel stocks and the metal stocks. We'll take a break and we'll analyze all these cues with Prakash Diwan, who joins us for some fundamental stock analysis. Later, we will connect with Itira Davis of Ujjivan Small Finance Bank to discuss their business update for the third quarter. Stay tuned.
Welcome back. You're tuned into Bazaar Morning Call. You're on CNBC-TV18. Hope you're having a good morning. Well, there are plenty of stocks to discuss. Prakash Diwan joins us to do exactly that. Hi, Prakash. Good morning. Well, quite a few of these banking names have been in focus, and we have some positive news flow on IDBI Bank overnight. What's your view on this stock? From year on, yesterday, all the banking names had a bit of an off day, but let's see whether or not they bounce back. Your take on IDBI Bank in particular?
Good morning, Nigel. So, you're right. Banking has been taking a little bit of a backseat in this softness that we witnessed. But particularly for this bank, I think the reset in the capital structure and, the regulatory overhang in terms of the government's ability to now offload as quickly as possible to third-party investors is going to be far more superior. I think it's kind of setting the tone for some sort of a transaction which hopefully gets triggered before March, because that's what would make meaningful sense for the other large shareholder, that's LIC. So it's definitely something that's taking shape. But there's no fundamental trigger to back any change in valuation in that sense. It's fairly well known and discovered that IDBI Bank would be on its way out in that sense. But what's interesting about the entire banking pack, Nigel, is that we've started seeing a lot of the smaller banks also strengthen themselves, while the bigger banks have always been, the top three. If you look at SBI, BOB, Can Bank, have gone beyond doubt into a trajectory of growth which is fairly impressive. But now it's the mid-sized banks, the smaller banks, that are coming in. So the last time I recommended that it's best to play the PSU pack through a ETF, if you will, because you really don't know which one will be actually taking off before the others. So it's best to kind of have a more diversified bet. But there's definitely one more round of re-rating that's very evident in the PSU banks, and you should miss out on that.
Okay. Prakash, up your alley, tire stocks. There is some interview with Anand Goenka in, I think, the Mint. And the talk is that the company has a target to reach $2 billion revenue in the near term. Sonia did some analysis and says that it's perhaps 2 years away. Maybe 25. But your thoughts, are tire stocks worth buying, raw material prices cheaper, and what would your pick of the pack be?
So, good morning, Lata. So, I think, the factors that are helping tire companies get back to their regular or long-term averages in terms of margins are very evident, whether it's rubber prices, whether it's crude. And there's a surplus capacity, or rather significantly huge capacities that have been created for some of the other, critical components or raw materials like carbon black and all. So all that put together does really make sense. If you look at CEAT, of course, they've done enough restructuring in terms of the balance sheet, also the debt repayment, and also we know about that. But it's kind of priced in, is my view. I would look at something like a TVS Sri Chakra. Again, that's a company that's focused on two-wheeler tires and has a very strong franchise. If there is a revival in the two-wheeler side, there's no reason why something like TVS Sri Chakra can't. Of course, it's a high-priced stock. People really don't want to talk about it as often. But I think at this 3,500 zones, it's definitely something which would probably get very good upside from here on, given the secular trend and the company-specific market share gains that it's making all this while.
But CEAT also is high priced, isn't it? I mean, it's always been ruling at high PEs, isn't it?
Yes, it is. It's like the baby MRF of the tire stock of sorts, yeah.
You know that Prakash, hi, morning. The shack look is very becoming of Goa.
I know it's a telltale. Yeah, I can't hide it.
No, don't try to hide
you
it.
mustn't,
Why should you hide it? Prakash, the one name which caused a lot of pain yesterday was Bajaj Finance, right?
Yeah.
It's widely owned across portfolios. At one point used to be the top holding across a range of... and by the way,
Yeah.
I put out a piece 2 weeks back on Editors Roundtable looking at Bajaj Finance
Yes.
and how it's had one of the worst years in 2022. Actually,
Yeah.
forget worst years. It's never had a down year. It's had, I think,
Down
one
year,
other
yeah.
down year. 2022 was one of them. And yesterday was down 7% after that operational update. Your sense from here?
Yeah, Prashant, you're right. So after 2018, I think this is the first year of disappointment in terms of their growth metrics. But the company has been growing at such a rapid clip. It gets difficult to sustain those kind of growth rates for too long. And the market is in a position that they're in a mood to punish things that really don't go their way. I mean people are waiting for the slightest of excuse to trigger a sell-off, and Bajaj Finance with its premium valuation definitely is ripe at times to do that. But there are some interesting changes in the company in the if you look at both the Bajaj twins, between the two of them, you have at least the AMC business that's likely to start coming up, and there could be some sort of a shift from a fund-based activity to a fee-based focus within the group, and that is something which a lot of people really don't want to own, because you have lots of other much more mature listed players to kind of ride that with. So the asset management business is something which is going to be significantly large for them, given their customer base, given the cross-selling ability. But all of that is something which makes for a shift, So the recipe is changing, is my view, and people just wanted an excuse to do that, and the update was probably just right. It may not be as bad for the coming quarter, which is the current quarter. But then, the skittishness in the market is probably largely responsible for the timing of this sharp fall.
Okay. Well, do stay on, Prakash. We have a few more questions for you. Maybe catch a cup of coffee in your shack, and we have to discuss Ujjivan Small Finance Bank. That's the first corporate that we are inviting today. This is after their third quarter business update. The bank has seen a robust growth in its disbursals, but not a very high growth in its AUM. The key positive, however, is Ujjivan Small Finance Bank's asset quality continues to improve. To discuss more, we are joined by Itira Davis, the Managing Director and Chief Executive Officer at Ujjivan Small Finance Bank. Mr. Davis, good morning. Thank you very much indeed for joining us. If you can just give us a little more detail about the state of the advances and disbursals. Are you seeing a strong credit growth uptick? What do you think you might end the year with?
Good morning, Lata. It's good to be here with Morning Call. Yeah, we have had now 3 to 5, actually 5 continuous quarters of growth. This is the 5th quarter after the COVID turnaround started, and the 3rd quarter of this financial year has seen about 33% growth in the loan disbursement, in the loan outstandings compared to the previous year. Now we are seeing good offtake of the of demand for loans, and that is expected to continue into the 4th quarter and hopefully into the new year as well. And I think even our deposit growth had been done in a way that we anticipated this growth in demand for loans, and we had prepared ourselves for that. So we were one step ahead, perhaps, of the market, and we have seen 49% growth in our deposit base, which is quite phenomenal at this stage of the interest rate cycle.
No, absolutely. But can you just explain why this disconnect between growth in disbursals and growth in AUM?
Yeah, we were using some of the other instruments in the market. So the AUM has come down a little bit, because we have done some securitization, but otherwise, the growth continues. We sort of took a conscious decision to look at different ways to manage the cost of funds, and the use of IBPC and other instruments has helped us to manage the net interest margin and the cost of funds.
Hi, Mr. Davis. But what kind of an outlook could you give us in terms of AUM growth and your dispersals on a quarterly basis? Can you maintain these levels?
Yeah, I think, normally for us, the fourth quarter tends to be the best quarter. And we are hoping that this year as well, the fourth quarter will be the best quarter. So far, the second quarter was a little ahead of the others. The third quarter, we couldn't match up by a short margin to the second quarter. But I believe the fourth quarter is going to be the best quarter going forward.
So for the year, the AUM growth will be approximately what?
The loan growth, we had given a market guidance of 30%, and I think we have already crossed that. So we will stay at about these levels or slightly higher.
How will this impact your margins? At what cost did you raise the deposits? Was it at a higher cost compared to the quarter ago? And will you have to give away something by way of margins?
Yeah, I mean, that is something that we had to be prepared for because of the interest rate cycle. The interest rates started going up about 6 months ago. And, the whole industry is finding that net interest margin is being squeezed a little bit. But we are trying to manage it to make sure that the decline is very, very nominal so that, the rate of return is maintained. Eventually, I think we are waiting for the February results or the February announcements from the Reserve Bank of India. Once we have those announcements about the interest rates, we'll have to take another decision on whether, we hike the lending rates, because we have sort of been holding back. Since this is a recovery from COVID, we have been holding back on raising the interest rates. We did it only once on the lending side. We may have to do it once more if it goes up again.
All right, Mr. Davis, 9.5%, you'll hold on to that, right? That was the earlier guidance.
Yeah, for now we are holding on to the interest rate, but if the February announcement makes a change, we may have to raise lending rates. Deposit rates, we are looking at the competition and keeping it that way. We raised our deposit rates 2 months ago, a little ahead of the competition.
Okay, all right. So we've got loan growth of around 30%, NIMs holding around the 9%, at least as of current reckoning. What's impressive in your numbers, Mr. Davis, is that the asset quality is improving. We have various experts, various companies that come on the channel, and they're saying the bottom of the pyramid is struggling and rural India is struggling. Now, you have some exposure out there, a large exposure out there. Could you tell us, how is this happening? How is your asset quality improving? And also, if you would give us a guidance on that front, because that's fairly impressive.
Yeah, what we have done about a year ago, we put in place a more robust process for collection and negotiation with our customers. So that is now fully operational and it's showing the results. We are happy to, understand the customer situation and if necessary, make settlements if that is the only way to come out of the situation and help the customer to get back on their feet. So, all sorts of ways in which we can help to redeem the bad loan position as well as the recoveries is good. But also the existing portfolio, what we have done is that we make sure that the zero bucket is well looked after, well managed at the ground level. And I think that is the big difference between pre-COVID and now. And I think that is something that we have learned on the run.
Okay, any guidance on asset quality? You're sure you'll be able to improve the quality or at least maintain it where it is?
We expect fourth quarter to see some improvement. I mean, we have seen every quarter on quarter, we have seen improvement and we expect further improvement in the fourth quarter.
Would you need to raise capital?
No, we have finished that exercise. In fact, we are happy that in the September period, we were able to complete our QIP. We raised the funds which was necessary to bring our minimum public shareholding about 25%. We were also able to do a sub-debt placement. So all in all, our capital ratios are north of 25%, which is fantastic. Back to pre-COVID.
Well capitalized. We got that. Final question, Mr. Davis, before we let you go. What's the progress on the reverse merger? If you could give us a timeline by when that is likely to take place?
The approvals are in progress. And I think, we are hoping that it can be completed by about June or thereabouts. But, we'll keep you updated as things progress.
Good speaking to you, Mr. Davis. Thanks so much for stopping by and giving us a fair bit of an idea of how business is shaping up as well as your outlook. We look forward to chatting up with you post your numbers. Well, time to slip into a short break. On the other side, Anuj Singhal will be joining in for a quick market setup. We'll also bring you the top stock picks for the day from our technical and F&O experts. Later on, we'll decode the stock market rally with our Momentumizer segment. And at 9:10, Nimesh will be joining as always with the standout brokerage report of the day. And before market opens in CNBC TV18 Stock Board, we will highlight all the top stocks in the news that you need to focus on for the day.
Welcome back to Bazaar Morning Call. Our friend Anuj Singhal is waiting by to give us his take on the trade setup. Anuj, an expected short covering did not work out as much. It did work out, but not as much. You think it comes back with a vengeance today?
Morning, Lata. Well, first of all, it's Friday, so that's good news. The market action was not as bad as the index suggested. In fact, the mid-cap index was well in the green, and a lot of individual stocks did well. For me, the big question is if the Nifty has made a double bottom, and in fact, a higher bottom compared to the last low. I'll discuss that. But we need to see the behavior of the bank Nifty, because for last 2 days, that's the index which has been the problem point, and within that ICICI Bank. The other point clearly is that China is emerging as a big theme for 2023 after December. In fact, in 2 months, Hang Seng is now up 45%. This week alone, Hang Seng is up 7%. So what I'm trying to say here is there is a lot of fund flows moving back to China because valuation comfort is there, and metals as a theme could extend itself over the next 2 or 3 months, which for Indian macro could be slightly troublesome, but that's something that you could keep an eye on. Purely in terms of levels to watch, yesterday's low was 17,892, which is higher than the previous low of 17,774. So 17,774 is now line in sand. On the upside, the resistance comes in at yesterday's high of 18,120. If you trade above that, maybe another excursion towards that 20-day exponential moving average of 18,250 or so is possible. On the Bank Nifty though, where we recovered 300 points from lows, what it did was that it managed to bring Bank Nifty back above a significant support level, which is around 42,400 thereabout. On upside, 42,800 will be a bit of a resistance. And of course, we need to see price action in ICICI Bank, because ICICI Bank is now trading below 20, 50 and 100-day moving average. If ICICI Bank has to slip to 200-day moving average, which is another 4 or 5% from here, it's corrected 9% already. It's the captain of the Bank Nifty. If it falls more, then there could be a bit of a trouble for the Bank Nifty, which is what the market seems to be indicating. But overall, I think it's still not showing signs of a complete breakdown. We still want to see how it behaves today.
No, absolutely. We'll keep an eye out on that, Anuj. Thanks very much for that. So that's the trade setup as Anuj sees it. 9 minutes to go for the pre-open session. Shrikant Chauhan is with us. Let's get a sort of view on the market with the technical lens. Mitesh, of course, is with us as well. Gentlemen, good morning. Great to have both of you here. Mitesh actually is with us here in our studios. Mitesh, what are you watching out for and how do you view things?
Good morning, Prashant. I think the first thing is, as Anuj was just pointing out, whether we managed to hold above yesterday's low. I think if that happens, then we will conclude that the break or breach of 18,000, which happened yesterday, wasn't conclusive, and therefore we are back into the range of 18,250 on the upside to roughly about 17,950 on the downside. I think if that happens, then maybe today could be a good day when you will at least see that movement, which will have the index move upwards towards the upper end of the range. So we'll possibly explore more of long ideas today.
Okay, got that, Mitesh. Well, let's get in Shrikant as well into this discussion. Hi, Shrikant. Morning. What's your sense on the index? Yesterday, it was looking like we were going to break down, but we had a last hour recovery. Your sense on it?
Good morning, everyone. I think the market has completed its first leg of correction. The market is in the range. It is not crossing the level of 18,250 confidently on the high side, and it is not breaking the level of 17,750. So till the markets are above the levels of 17,900, we are expecting market again back to the levels of 18,150 or 200, where it has huge amount of resistance. And when looking at the entire pattern, I think the markets are trading with a negative bias. So in case if we see the markets are opening somewhere close to 18,100 or 150, then there we should look for avoiding taking any long positions. Yes, but in case if we see the markets are opening somewhere close to 18,000, then there we should look for adding some long positions, because again, we can expect some rebound during the day because number of stocks have fallen to their extreme level. So broadly, we are of the view that we should be buyer if there is like any lower tick during the day, somewhere close to 17,900 or 950 with a stop loss at 17,850.
Got that. Shrikant, at least the early morning cues from the SGX Nifty is indicating a better start. Mitesh, what are you trading?
So, in line with my view, Lata, I have more of buy calls today. Ashok Leyland is a buy with a stop at 145.5. And look for targets of around 156 to begin with, though I suspect eventually the stock might do higher levels. A buy on REC, and both the REC and PFC, I think both these stocks have been buzzing for last few days, making new highs. So REC is the recommendation today with a stop at 120. Look for targets of 130 here. And tire stocks were in action. So we had a breakout on Apollo Tires. Disclaimer, we have some long positions over here. Apollo Tires is a buy with a stop at 328 for targets of 360. And one sell call, that's on Chola Finance. Keep a stop at about 700 or just above it and look for targets of around 650.
Just to make one point on PFC, besides valuations and what's going on in the power sector, I'm reading a note from Nuvama. Well, they are alerting that there's a MSCI standard index rejig that will be taking place for February. So the stock needs to get to around 170 to confirm its chances of getting into that index. So that could be another factor. And that's why maybe in the last 10 days or so, the stock is up closer on 10-12%, while the markets are a bit wobbly. So just thought we'll highlight that for our viewers.
Okay, it has an index presence, likely index presence.
Could be included in the MSCI.
Mitesh, sorry, any thoughts on Bajaj Finance? We saw a big break yesterday.
Prashant, I had actually covered this stock in charting technicals last Tuesday and had talked about the fact that the lows of 5,500, which the stock did when the index had corrected to 15,000, I think those should be revisited. So I think we are well on our journey towards that level. I think around 5,500, 5,450, the previous bottom, as well as the fact that the indicators will be oversold, should give it good support. So another 10% lower, I would want to see some kind of rebound, but for the time being, it's a sell for me and negative view.
All right, Shrikant, what are your stock picks?
Yeah, I think we need to focus on BFSI as well as capital goods and engineering stock because there is like a huge amount of interest. Also, a few metal companies are going to do well and FMCG stocks on the back of falling the crude prices. But we like Hindalco, which was around some 490 levels. From there, all the way it fallen to the levels of 460, 65. So it is at its important support area. So from here again, we can expect rebound. Hindalco is a buy at current levels with a target of 480, 85 on the high side. We can keep stop loss around 455 for buying Hindalco. And we also like Canara Bank from the BFSI sector. There also we feel that stock may again come back to the levels of 340 and we can keep stop loss around 320.
Okay. Gentlemen, thank you very much. We'll come back to you for more advice. A quick break now and we're going to come back with also the pre-opening rates. We will also be joined by Dayanand Mittal of JM Financial Institutional Securities for a chat on the oil and gas sector after the sharp decline in crude prices.